When we prepare financial statements, we want to show the users of the financial statements a summary of the transactions that the business entered into for the financial period. This helps them understand how the business has performed during the preceding year. In the process of preparing the financial statements, we tend to recognize assets and liabilities on the statement of financial position. These assets and liabilities that we recognize today give us an indication of the cash flows that are going to occur in the future. For example, let's say that a business purchases inventory. The business would recognize inventory on the statement of financial position at an amount of, say, 1 million rand. But have you thought about what this 1 million rand actually presents? This amount represents the minimum economic benefits that we expect to receive in the future when the inventory is sold to the customer for cash. Of course, we know that the amount would be greater if we are selling inventory at a profit, but we are recognizing a minimum amount. At a minimum then, we can say that we expect to receive 1 million rand for selling the inventory. But does this 1 million rand represent the economic benefits that the business will be solely entitled to? Can the business take all of those benefits and solely profit from them? Well, not really. When the business recovers its assets in the future, or when it settles its liabilities, there will be future tax consequences. If the business generates a profit, SARS will tax that profit at the prevailing company tax rate. But hang on, this presents us with a problem. We are showing carrying amounts for assets and liabilities on the statement of financial position that have future tax consequences. This presents an incomplete picture of the business's financial position at a particular point in time. It would not be correct to report the carrying amounts of assets and liabilities without reflecting the effects of the future tax consequences. This is why we need deferred tax. We need to show users of the financial statements the full picture. Deferred tax is the mechanism we use in accounting to adjust the tax expense to ensure that we recognize the tax consequences when the transactions giving rise to the tax occurs. It gives a fuller picture of the tax effects that will occur in the future because of the transactions recognized today. So let's take a look at a practical example. Imagine that a customer pays a business 100,000 rand in advance for services to be rendered in the following year. The business would recognize income received in advance in year 1 because the business has not provided the customer with any services yet. In year 2, the business would recognize the revenue when the services are performed. But what happens to the tax on this transaction? Is the business able then to recognize tax if and when it sees fit? No. Firstly, the income received from the customer would be included in the gross income of the business, and it will be taxed at the prevailing company tax rate. This is driven by the rules of the Income Tax Act, which differs from the accrual basis of accounting which we use when we recognize the underlying revenue. When the business performs the services in year 2, there will be no current tax consequences to the profit being recognized because the tax paid in year 1. If we were taxed again in year 2, that would be considered double taxation, and luckily it isn't happening. However, it is important to understand that the tax we recorded in year 1 relates to profit that is being generated in year 2. And if we weren't generating any profits, there wouldn't really be any taxes for us to pay. Therefore, it would make more sense for us to recognize the related tax when the underlying profit that gave rise to the tax is actually recognized. This means the financial statements make more sense when we look at the bigger picture. The way we do this is to recognize deferred tax in year 1 of 28,000 rand. This will bring the reported tax expense to 0 because the tax expense in the financial statements is current tax plus deferred tax. We show our tax expense on the income statement as the sum of these two. We can then reverse the deferred tax in year 2 so that the profit recognized has an associated tax being recognized in the same period. This matches the tax on the profits to the period in which the profit is being recognized. By doing this, we can show the users of the financial statements the economic reality of the transactions. In year 1, we had no revenue and therefore no tax. In year 2, we made 100,000 Rand in revenue, and that revenue was taxed at 28%. And this, of course, makes perfect sense. The profit recognized in year 2 is 72,000 Rand, and this is more in line with our expectation of the nature of the transactions. Now we are happy that there is a consistency in how we present the financial transactions and related tax expense in the financial statements. So what is the moral of the story? The moral of the story is that in order to know accounting, you must know tax. They go together and cannot be separated, just like true love.